Welcome to this video on the shocking prices of new and used cars and what it means for dealer stocks. If you're in the market for a new or used car, you've probably been surprised by how expensive they've become. And if you're a dealer or investor, you're probably wondering how these prices are affecting the market. Well, in this video, we're going to take a deep dive into what's driving the skyrocketing prices of cars and what it means for dealerships. First, let's start with some personal anecdotes. The narrator tells us about his leased car, which is now worth more than he anticipated. It's a mid-size, mass-market sport utility vehicle leased in September 2020. The lease is based on a $40,000 purchase price and a $26,000 residual value at turn-in. He's running so far over his mileage allotment that he's starting to suspect himself of sleep Uber driving. Yet, he sees identical, high-mileage cars selling now for $33,500. If those prices hold for a few more months, he'll be up on his buy option by 29%. This personal anecdote is not just an isolated case, but rather a reflection of what's happening in the market. The Manheim Used Vehicle Value Index is up 35% since September 2020, which is way above the performance of the S&P 500 index over the same period. This increase in used car prices is due to a number of factors. Initially, car production plunged amid a chip shortage, and buyers turned to used vehicles for lack of other options. Now bottlenecks are easing and inventories are rising, but car makers remain cautious. The industry has gotten used to plump profit margins, and with financing rates sharply higher, the outlook for demand is unclear. Meanwhile, leasing has fallen out of favor, and many drivers with existing leases face favorable math like the narrator, so they buy their cars rather than turn them in. That has crimped a key source of supply for used car lots and sent dealers bidding up prices at auctions. Increasingly, they're competing with the rental companies, which typically buy new, but manufacturers have shut down low-margin production. Put it all together, and buyers are in a difficult spot. Prices for new models are up 21% since September 2020, according to government inflation data. That tracks with the narrator's car. A new one with similar features now lists for $48,000. Until recently, that price would have felt like a minor splurge. Last month, it was more or less the average new vehicle transaction price, according to Edmunds. In a report this past week, Edmunds called sub-$20,000 vehicles nearly extinct, and ones under $25,000 next in line. Just 17% of new vehicles sold last month were under $30,000, versus 44% 5 years ago. So, what does this mean for dealerships and investors? Used car chains that cashed in during the pandemic are looking humbler now. CarMax is expected to show an 11.9% decline in same-store sales, and their stock is down 34% in a year. On the other hand, new car dealerships are doing better, with limited inventories holding down the cost of stocking showrooms, and little need for discounting. Profits per vehicle are up. Their stocks have done decidedly better of late but still trade at low price/earnings ratios. There is a contentious debate over whether new car dealers are over-earning. Analysts like ones with a high mix of luxury vehicles, limited exposure to manufacturers that might ramp up production too quickly, and sales footprints.